Good afternoon. Welcome to this rundown for global stocks and commodities for the 7th of May. Global indices, or certainly many of them, hit new highs through the week. And this has created a dilemma for, I think, quite a lot of people. And I've been getting quite a few emails because people are feeling that this is a time of year that you should sell. The sell in May, go away theme, which frankly doesn't have a statistical basis to it, but it seems to be something that a lot of people pay attention to. So there's this dilemma created by markets still going up, yet this sort of underlying feeling that there's impending doom and gloom and the market's going to fall. So look, I want to dispel some things today and try and give you some peace of mind around that. So let's first of all start with just a general perspective. From an economic point of view, Europe is accelerating. There's no question about that. The PMIs, the Purchasing Managers Indexes, are expanding at the fastest rate in 5 years. So, that's hardly an economic zone that's in trouble. And there are many indices in breakout mode, some to all-time highs, some to multi-year highs. But certainly the trends are quite robust, particularly in Europe. Now, there was also some lackluster data coming out of China during the week, but look, we've seen this story so many times, and so what does it really mean? One data point, and just to underscore that, there was, yes, a 6-month low in the PMIs, but that followed a 5-year high in March. So, why are markets reacting so badly to one figure? And I think that was a good part of why copper and base metals got absolutely smacked during the week, even though the US dollar went down. I think all of a sudden, people are looking at China and saying, there's trouble in China again. Iron ore prices were down around about 8%. And I just think it's an overreaction to be going that way on just one data point. It bears watching. I'm not saying that you should just ignore it and hope it goes away. It certainly bears watching, and I'm going to be doing that. But at the moment, there's no basis to panic, because even though it was a 6-month low, it was still above 51, and anything above 50 in the PMI indicates expansion. So there's still expansion happening. It's not like the economy has gone into reverse. The US earnings season is about 2/3 of the way through now, and it's certainly validating the rally. We've seen S&P earnings up 15% on average. Also, we're seeing a very significant level of companies that are raising their outlook further. So it's not only that earnings are at quite a robust growth level, but the companies are saying that this can continue. And also, too, we're seeing strong top-line growth as well on the sales line. So it's hard to manipulate the sales data, and that's pretty strong as well. So what I'm seeing out of the US earnings season certainly supports this rally that we're seeing in the market. But just in case, this is what I'm watching. Junk bonds relative to high quality bonds is an important ratio, and so far it's pausing a little, but there's certainly no downturn yet. So people are still quite comfortable to be buying into the slightly higher yield junk bonds. Personally, I think it's an absolute sucker bet, but nevertheless, that's what they're doing. So it's indicating that people are quite confident about the economy. I'm also obviously watching all of the stock indices for a change in character, and I'll look yet again at the S&P just to try and soothe those that are worried about it, just to show you that what a real market top looks like, and now we don't have any change of character at all. I'm also watching currencies closely, particularly the US dollar. A lower US dollar is favorable for US international stocks, which would obviously help support the market. So let's look at American stocks now. The S&P put on 16 points for the week, and on Friday night it was a new all-time closing high, and when you see the chart, I don't think anyone could deny that it's basically poised for a breakout from this consolidation that we've had. The other key element, of course, is this is not a rally in the index that's being driven by the top 10 biggest stocks. The market breadth remains very strong. The NYSE advanced decline line is still rising, and it's rising in concert with the S&P. So this is broad-based. This is across the board. Technology is still leading the price trends, and encouragingly, it's also leading the earnings performance. So again, we're not seeing a situation where the technology stocks are being bid up and it's not being supported by earnings. The earnings growth in that sector was the strongest. And if you've got any interest, just have a look at the results that Facebook put out through the week. They were very, very impressive. And I've got the next slide. I'll just show you something relating to another technology major. The thing to remember is that stock prices will precede economic recessions by 6 months plus. So we're not seeing any signs at the moment that stock prices are turning down. So those that are trying to find fault with the US economy, it's certainly not being indicated by stock prices, and therefore I think is some time away, if at all. It's really just a matter of simply watching the charts for a change of character. That's what you're looking for. If you're nervous about the market, I can understand that. The media is in full voice at the moment about sell in May and go away. Other people are pointing to the fact that we must be at a market top because this has been going for a certain amount of time. I mean, that's just such a rubbish argument that I've ever heard. The fact that the rally's been going for 7 or 8 years. I mean, so what? It could go for 15 years. That in itself is not a reason to be getting out of the market. So just keep a close eye on changes of character, and certainly that's what I do. And I'd just like to ask you to consider this. What if Trump gets even some of his tax reform through? And I refer to this quite regularly. The media is only running with the corporate tax cuts. There's many other elements to his reform package that I think are absolute no-brainers. Can't believe the Americans didn't do it 20 years ago, that relate to border taxes and cash flow taxes. That would just be hugely stimulatory to the American economy. So I think the odds are skewed heavily to the upside for both the economy and for stock prices. But look, having said that, we have just had one heck of a run. I think the odds are rising that we may get a short-term pullback, but I can't see a lot in it. Perhaps 3%, 5% at the most. Now, this is a chart of Amazon, which really underpins what I'm saying about the strength of the financial results. The red line is EBITDA. Just think of that as profit for those that don't want to get into the nitty-gritty accounting formulas. So the red line is profit, and you can see that the profit really started to accelerate in 2010, and it's gone absolutely ballistic in the last couple of years. The other key one, which is even far more important for me than profit, because again, it's a number that's extremely difficult to manipulate, is free cash flow. So that's the light blue line, and just look at how free cash flow has exploded, and that number there is close to $10 billion a year of free cash flow. So those that want to find fault with the American market and just tell you that all these stocks, Google and Amazon and Facebook, are just overhyped and overvalued, you just need to embrace this chart to see what's really going on. Yes, there was a period here from 2010 to 2013-14 where the free cash flow dropped off. That was while Amazon was investing heavily in its future. and that future is now starting to pay off big time. And they've become so big and so dominant that it's really hard to see how that's going to be overturned, because they can just pretty much buy whoever they want to buy. They've done it very well. But look, there are others, and there are certainly others in China that are on a same or even better track. So some very impressive things happening in American technology. Let's take a look at some charts just to illustrate the point. I'll start with Europe this time, because these are really important charts. Everyone's freaking out about the French election today, but this is the CAC, the French 30 index, and just look what it's done over the last 3 months, 3 or 4 months. It was down at 4,400. Now it's at 5,400. That's nearly a 25% gain this year. Now, if we pan right back, you can see that we're not up to the all-time highs yet, but then again, the French economy is in a, not exactly in a great position, but clearly recovering. But if you look at the last 3 or 4 months, it's been really quite strong. You look at the German DAX. The German DAX is at all-time highs and really accelerating. Look at what it's done since the 20th of April. It's gone from 12,000, big breakout now, 12,700. That's been a very powerful run. And if we look at the FTSE as well, this is big picture on the FTSE. So you can see we had 1 in 2000, 2 in 2007, and then 2014-15. Bit of an initial breakout, failed, but now we've had a big surge. Look at how strong that surge in the FTSE has been, and the low point was in February, and then despite Brexit, we then have just continued to rocket up. So a great deal of strength in that market as well. Now, looking at the VIX index, the VIX remains at an exceedingly low level. Some people look at that and say, well, that is proof of complacency. But look, I think it's just, at the moment, it's a reflection of the fact that we've got really accelerating economic data. Now, finally, let me get to the S&P. That's the big picture on a monthly chart. Let's zero in a little bit on the daily chart. So clearly we're at all-time highs, and this was an all-time closing high at 23.99, so virtually 2,400 points. Given the way that technical patterns work, I think it's highly likely that we will get a breakout just to satisfy those that want to jump on board. I think that'll suck in a lot of unwary traders and investors, and then I won't be at all surprised to see a bit of a pullback. Might pull back into the perhaps the 2370, possibly even 2340 sort of area. So we may pull back into this area here, but look, I think that's just going to be a temporary pause. But certainly we've been in consolidation now since February, and that looks like that consolidation is coming to an end. Let's just check in on the other parts of the American market. This is the NASDAQ. You can see continues to march on. And this is, I guess, one of the reasons why I'm expecting a bit of a short-term pullback, because the NASDAQ is now as far above its 50-day moving average as it normally gets. It's well overbought. So this would be an appropriate point to get a bit of a pullback. But look at the last time that happened. That was in March. It didn't pull back. It just went sideways, and the moving average caught up to it. And it's entirely possible that could happen again. So when I talk about a pullback, it's really a bit of a minor event. It's really just whether you want to use your capital to greatest effect. And now let's look at the Russell 2000. Let's check in on what the small caps are doing. So basically up close to all-time highs, but certainly no weakness in the Russell. It's not rolling over in any shape or form. Now I mentioned currencies. This is the US dollar. We've had a breakout above 100, a pullback to the 100, and now you can see we've now slipped into a downtrend. We're now basically forming lower highs and lower lows. So we're forming a bit of a channel there. I don't know how far down it might go, and I guess that makes the declines in the Australian dollar and gold and copper and oil even more interesting. That the falling US dollar should have provided a bit of a boost to all of those currencies and commodities. But the selling has been so strong for other reasons that it's overcome the currency effect. We may as well look at the Australian index while we're here. Pretty lackluster week considering what was going on around the world. So you compare that with France, with Germany, with England, with the US. It's a pretty sad chart, really. So we're unable to break through this 6,000 level. We're still forming slightly higher highs and higher lows, but our market is looking very shaky indeed. But look, that's just a reflection of the banks and the major miners and a couple of other large stocks. And to me, it doesn't really tell me a great deal at all. You've got to look at the broader Australian market. This is the Australian dollar. We had a range which had set up since around about January. So that's been the range for this year. We've now dropped out of that range, and we may now perhaps test down towards the 71, 72 mark over the next few months. So that's the situation with the Australian dollar. So Aussie stocks, Aussie dollar finished 74.2. There was certainly weakness in iron ore and other commodity prices, and that's what helped drag our dollar down. And the index down by 88 on the week, and really pretty sad considering what's going on elsewhere around the world. There is no question that we've got I'll call it a basket. It's not a very big basket of really good companies in Australia. Almost all of them have got global businesses and get most of their revenue and expansion from overseas. And that's the saving grace for me. But they've always been pretty much overvalued, both fundamentally and also from a technical charting point of view. Now, some of those are pulling back. So there are a few opportunities in Australia, and I'm introducing those to members as they would know. I don't know how far that those stocks may go. I'm not expecting great things, but if you can buy a dip, then you can pick up 10 or 20% fairly quickly on a rebound if you've done your homework well. So I think it's perhaps time to get a little bit active again in the Australian market. But look, you need to be highly selective. There wouldn't be 40 stocks in the Australian market that I would be prepared to back at this stage, and you've just got to be very, very patient for the dips. So it's still not easy going in Australia. Precious metals, ugly week, down nearly $40 to $12.30. So we broke the key support of the 200-day moving average, and that was pretty surprising given the lower US dollar. There are some really complex cross currents in precious metals at the moment, and I would defy anyone to make a prediction with any degree of confidence about where the gold price is going in the short or even the medium term. So I see precious metals as a trading vehicle only, and only at the extremes. I think if you try and do anything else with precious metals, you're probably going to get a kick in the pants. So very, very difficult market, precious metals. The positioning in the futures market, I've spoken about this nearly every week. We did get a pullback in the speculative longs for gold about 2 months ago, and that set up a bit of a rally in gold. But we were still significantly long on silver, and that is now unwound in a big way, and silver has dropped from 18 $18.50 down to 16. So there's been a real smashing in silver. We're now oversold, so I think you can probably expect a short-term bounce. But frankly, I've lost confidence in the sustainability of the bounce. So for me, it's purely a short-term trading vehicle, because there are things happening in that market that basically aren't consistent with what I would have expected. And I think it's a combination of a lot of things, but the main one probably being the fact that markets are now very much in risk-on mode, and therefore the safe haven of something like precious metals is not deemed to be important. Just before I go on with other commodities, let's take a look at the precious metals market. So we'll start with silver, and you can see it's been an ugly slide. Started in the middle of April at $18.50, and now we're almost down to 16. And we've broken these lows. So very, very oversold, deeply oversold. So you may get a bounce, might bounce to 17, but yeah, as I said, no real confidence about calling a more significant bounce. This is gold on a weekly basis, so you can see it was not huge, but it's certainly sharpish. And if we go to the daily, you can see that we managed to get above the red 200-day moving average line. We made that break on the 11th of April, but it only lasted about 2.5 weeks, and we've clearly broken it decisively, and there's been some decent follow through. I wouldn't be surprised to see gold rally back to the 200-day, which now becomes resistance. That's around 250, and then perhaps fall away again. So we could see gold sub 1200 over the next few weeks or few months. So not what I was hoping for in the precious metals market. But you've just got to recognize that your timing is wrong, and you've got to back out of it, and you've got to fix it. There's no point in trying to flog a dead horse. If you're long the gold market, particularly if you're significantly long the gold market, then you've just got to recognise that the timing is not right at the moment, and back out of it and go with what is working well. Copper was weak, 252, and again I think that's probably China related, even though it would have had a bit of help from the US dollar going down. Crude oil got belted because of higher inventories down to 46.5, and I think part of this was the unwinding of excess in the futures market. The same has happened with silver. There was a real excess that built up there, and that just has to get unwound. It's just the way that it is. So I think the low 40s is a target for oil, but. And I'll make this point. I was of the view that we may see a move in time back to $80 a barrel in oil. But look, frankly, the US production has brought their costs down below the $50 level, and now that they've done that, we may be closer to a new normal with oil trading in a range of 40 to 60. 40 is perhaps uneconomic for some, but 60 is probably quite economic for a number of producers in America. So it may well be that we're going to struggle to see oil back above $60 a barrel. There's the spot copper chart. So you can see we went right to the lows of that range, around 250, and then a little bounce at the end. This is the crude oil over the last 3 months. So we've slipped back from 54 back to 46. And just on a bit of a wider view, there's the 2-year view. So coming down from 60, hitting a low at 30, bouncing to 55, and now coming off the boil again. So I'm expecting that perhaps we might see the lows somewhere in this area here between 40 and 45. So to wrap it all up, what about the sell in May and go away concept? It's only worked in 4 of the last 11 years. So why do people make such a fuss of it? Because it doesn't work more often than it does work. So why would you pay any attention to it? Just my advice to you is focus on what's working and forget the rest. Um, what's working is US technology, US industrials, healthcare, and China, particularly in China internet stocks. That's what's working. So focus on that. There was one other thing that I was going to do that I omitted to do. Let's just go back and look at the S&P. Okay, so let's go back and look at what a top looks like. So we'll go back and look at what the top looked like in 2008, and we could look at 2000. They're all pretty much the same. I've done this many times, but really just for the benefit of those that are feeling nervous about what's going on at the moment, that are reading and hearing that a crash is imminent, and there's lots of brokers that are keeping their clients out of the market because they've got this preconceived idea that the market must go down to a certain level. You've just got to stop doing that. You've just got to play the market as it comes. Get away from the predictions. Just forget about them, because you don't know what basis whoever that is has made that prediction on. It might be no basis at all. This is all you need to do. Through this period here, we had an uptrend. The red line, the 200-day moving average, is moving up. The dips below the 200-day moving average are brief and shallow all the way through. The 50-day moving average, which is the blue line, is above the 200 almost all the time, and the price spends a lot of its time above the 50. That's a positive orientation. Now, when you should stop buying is when you start to see a change of character. Was this a change of character here? We had a little bit of a sharper pullback. Probably not. Hard to call that. But look, this certainly was. So we saw a change of character, a sudden downdraft, and that occurred in August of 2007. This is nearly a year before the real meat of the GFC. So there's the change of character there. That's as clear as can be. We spent longer under the 200-day moving average. The daily ranges were bigger. The sell-offs were much, much sharper. We had a lower high and a lower low. So there is your warning shot. Now, if you keep buying after that, then you're crazy. That's when you want to stop buying, when you see that sort of activity. Now, almost inevitably, because of the way human psychology works, you get a bounce back. And in fact, we went back up and formed a slightly new high. That's the opportunity to really start lightening off if you are heavily long the market. So you've just got to pay attention to these signals. Now, it's still not definitive, because this is the initial swing low, and we need to see that low broken to be definitive. So at this point here, which is August 2007, you could have drawn a line in the sand, and that was at 1,400 points. So you could have said to yourself, okay, that's the confirmation that I'm looking for. So between August, we then had another decline, came down in November of 2007, another bounce, and now we're starting to get a series of lower highs. So this is all starting to add up now. Lower highs, 4 of them, but we're still only December 2007. We haven't even come into 2008 yet. So for those of you that are worried about a market crash, you just don't. There's just no point to it at all, because the signs are generally pretty clear. Now, so during this period here, from August through to December, you should have made substantial adjustments to your portfolio. You should have stopped buying, and you should have started taking profit. Now, the ultimate breakdown occurred here in January, and then we bounce around for a while, and it's not until June. So that's 10 months after the first warning sign before the market really started to fall apart. So 10 months. Please remember that, and just stop stressing about a market top occurring without warning, because it just doesn't happen that way. So having made that point as emphatically as I can, let me just wrap up. Stop listening to predictions. You've got to think unemotionally about the market. It's so important. Don't be thrown off by short-term weakness. Look at that S&P chart or whatever chart you want to look at in that sort of, simplistic, dispassionate way, because that's all you need to do. And don't be influenced by the media data grabs. We've seen a huge reaction this week to a weak Chinese data report. Commodities got really whacked, but that could easily reverse next month. And look, just have the courage of your convictions about what you're doing. Bit long this week, but I thought really important. There's my contact details for anyone who wants to communicate with me. And as always, I'm sure we'll have another fascinating week ahead of us, and I'll be back with you then. Cheers.